If you have a 401k at work, chances are you might have access to something called a target date fund. Now, a target date fund will be based on the year that you're going to retire, whether it be 2030, 2045. So if you're going to retire in the year 2040, you'll buy a Target 2040 fund. The idea is a one-size-fits-all. You don't have to think much, just invest your money in this fund and you're done. The problem with these funds is that they have a tendency to focus on areas of the market that we're more familiar with. For example, a Target 2040 fund would be mainly stocks, but what kind of stocks? Mainly large U.S. stocks in most funds. Now, why would a fund company do this? Even though the long-term expected return for large U.S. companies would be lower than other areas of the market, like small value and large value, other areas of the market would have higher expected returns. They focus on that area of the market that would have lower expected returns, not because of the return issue, but because of something called familiarity bias. Let's say that you're a fund manager and you manage a fund and the market goes up. If the fund that you manage for the investor goes up, your job is safe. If the market goes down and your fund goes down, your job's still safe because people are standing around the water cooler, well, the market's down, it'll come back. Well, that's true. But here's the third scenario. Let's say that the Dow, which is what most people think of as the market, goes way up and your fund only goes up a little. You're an idiot. You don't know what you're doing. Well, fund managers don't like that because you'll fire them. If the market goes down and your fund goes up, they're going, wow, you're a genius. Well, they know that's not sustainable. What is safe for them from a marketing standpoint is to look like what we perceive to be the market. Move up when the Dow moves up, move down when the market moves down. The problem is what you end up with is more risk and many times less return over time. Target date funds are not a great alternative. Typically, we look at allocating and helping people allocate the portfolios themselves to come up with better long-term expected returns and better risk-adjusted returns.